JJ, the CPA is here. Let's go, let's go. Yeah. Money. You know what it be. All I do is work, cause money never sleep. You never met a CPA quite like me.
JJ, the CPA here. Hope you're doing well. I am on vacation. We have been scrambling to get Wi-Fi set up and get this ready to rock and roll for you. I'm doing a little vacation in the southeast part of Oklahoma. Just drove down here and we're going to spend a little time at the lake. We got to have a great Father's Day weekend. And now we're going to have a little bit of R&R coming into this week. You're going to probably hear a little bit of background sound. Remember, we're not at CNN. I'm a certified public accountant. And I'm in the trenches. I'm doing taxes. I'm working with clients. This channel's put together to share the working knowledge that I have with hardworking small business owners and self-employed just like you. And this is JJ the CPA Small Business Toolbox.
The combination to money making, we got this. JJ the CPA is the master locksmith.
So today I thought it was important that we still go live. We'll probably have a little bit of an abbreviated show, but I want to talk to you about banking and kind of the cash flow and bank reserves and things to do to prepare. Now, no, you're not going to find me like trying to cause some kind of panic for you. But when I'm talking with my clients and I find that there's things that are helpful to them, things that they're interested in, things that I see that they're being affected by related to banks, then it gives me a good idea of some content, for lack of a better word, to share with you. Now, if you're looking at the thumbnail that I provided, indicating we've got PPP and the EIDL and we have bank disaster, a couple of things I want you to note is I don't think we're going to have banks going out of business. I think what we're really going to have is banks very willing and wanting to loan money, but not having the reserves to loan like they should. So very recently, and I have links in the body of this video, the CEO and CFO, respectively, of Wells Fargo and JP Morgan, no, they didn't tell you to go run for the hills and there's going to be a disaster. What they're talking about is that in their own banks, these are very obviously large banks that do a lot of business, not only probably with you, but also with smaller institutions. But they are indicating that in the upcoming quarter and in the upcoming year, that they expect to be a lot more conservative with their assets. So there's a number of things that have come into play. I do want to walk through with you kind of a top 10 of things you should do now. And guess what? None of them includes you running to the ATM and pulling out as much cash as possible. None of it includes hokey stuff that you may see in articles or clickbait. What I'm giving you is practical information that I'm talking about with my clients. So as a certified public accountant, I've got over 30 years of experience. When I'm dealing with my clients, which also means that I'm dealing with you, I have to provide good information that I feel is true, correct, accurate. And that is part of why I feel the CPA community is held in essence, a high esteem for giving advice that can be counted on. Same for my fellow enrolled agents before the IRS and tax pros. And many times you may have a professional working with you, your investment advisor. And that is definitely a key voice to be listening to as well. And you might want to be getting in touch with them. But when we're talking about kind of, well, what's going on with the PPP? So I do want to make sure you know that there's not another round of PPP. So may have lost some of you right now that aren't now going to continue to listen because you thought maybe I was going to tell you there was more PPP. Hopefully that was not your understanding. But the thing that we have with the PPP creating loan issues is that the PPP, when given out by the banks, it came from their own funds. It came from their own reserves. And when the pandemic hit, and this would be in March of 2020 in terms of when things shut down, The bank reserve requirement went to 0%. And doing my own research here recently, it still seems to be the case. So the reason this is important is that the banks, when giving out their own money for PPP, they do not get paid back or get those funds until that PPP loan is forgiven. And so that's kind of maybe a little eye-opening why we had many banks really pushing for those that got the PPP loan to get that application in and to get it forgiven. And we know that right now there's going to be a very heavy time of PPP loan forgiveness applications being submitted, if not already, because we know that those that got PPP in 2021, at the earliest times they could have got it. If you take in January, February of 2021, and you take 24 weeks from there, which is the covered period, plus 10 months, which is then the period of deferment for making any kind of PPP loan payments, that puts us right now where we are, where PPP loan payments, the deferment is over. And so if you haven't filed for PPP loan forgiveness, then the bank's going to say, hey, you need to start making a loan payment on that. And why is that key to what I'm talking about right now? Well, that loan rate is 1%, first of all, for those that are now going to have to start making payments on it. I would say, and I've not seen a number, so this is just going to be based on what I would call my expert advice or expert opinion, I should say, is that when I look at how much fraud there was as it relates to PPP, and we're still probably getting the number around that, but it's somewhere around 100 billion with a B, 100 billion in fraud. And when I kind of look at that from the perspective of what might be the amount of PPP loans that would be unforgiven outside of fraud. So this would be those that got the PPP loan, but they didn't get it all forgiven or won't get it all forgiven because they didn't have enough payroll, didn't use it on payroll, or they got it inadvertently incorrect. Somehow they may have put information in that wasn't fraudulent, but they put information in thinking they were getting a certain dollar amount. But now that it comes time to forgiveness, it is not something that is then forgiven. And why is this important? Why is this important to you if you already got PPP and you already got your PPP loan forgiven? The reason it's important to you is that banks across America were giving out money for PPP out of their own funds, which is out of their reserves. And if there is now 100 billion or so of fraud, I would assume the SBA is getting those banks repaid unless the bank was, in essence, really lacking judgment and allowing that PPP loan to go out. So there's 100 billion in fraud. I also think there's then 100 billion that the banks are going to be stuck with a repayment that's over 5 years from those that got the PPP loan but didn't get it forgiven, and that's at an interest rate of 1%. Why does this matter? Well, because banks are using their reserves now in a manner that they really probably didn't intend when PPP came out. Now, we know that when the original PPP, the Paycheck Protection Program, was brought onto the scene, which was really in April of 2020, that potentially was unprecedented, that the banks were giving out money, if you will, to small business owners on behalf of the government, expecting that the government is going to repay them in the entirety. And when it originally came out, the loan rate for repayment was at 5%. Then it went to 3%, and then it stuck at 1% pretty quickly. So if you have banks that now, in essence, have used reserves expecting to get them back, but now they're not, and they're now getting repayment on those loans at 1%, they're not making as much money. And guess what? Banks, their number one and primary purpose when they give out a loan, and the reason that they're wanting to get it repaid, is that in essence is what keeps that bank going. Yes, they want to make interest off of it. So it's not so much that I want you to go, well, why should we feel sorry for the banks? I mean, so what? They're only making 1%. Okay, they're only making 1%, but the thing I want you to really hear is they've used up reserves, still using up reserves, still haven't gotten all PPP loan forgiven that they gave out. So they still have to have reserves on hand that then doesn't allow them to be able to lend out as much to those that have other banking needs. Now, let's talk about the EIDL, and I am going to circle back and talk about the PPP some more. And I am going to go through the top 10 and give me about 3 or 4 more minutes, and then I'm going to go to the top 10. But with the EIDL, I've been talking about this from the beginning, is that with the economic injury disaster loan, this was nothing new. Now, many think that the EIDL came out or came into existence because of the pandemic. And that's not the case. The EIDL has been around a long time. It really was created to help those that were in natural disaster, such as a hurricane, tornado, drought, you pick it. And when the SBA then, in essence, is helping businesses that have an economic injury, it is then, in the past, businesses that were truly suffering an economic injury. Because, see, before the pandemic, you applied with the SBA, very similar to how you got an EIDL during COVID. You would apply with the SBA. The SBA would give you $10,000 very quickly to help with immediate cash flow needs. But then once the SBA approved you for an EIDL, they didn't just give you the money. There was then an agent assigned to you, because you have to remember, typically, if we're talking about a disaster that's a natural disaster, it's not nationwide. It would be in a finite area, and there would be enough agents nationwide with the SBA to then, in essence, oversee those businesses that were needing help that then qualified for the economic injury disaster loan. This is all before the pandemic. And that agent then would work in conjunction with that business owner and very much then keep tabs on them. And as the business needed money, then the SBA gave it to them as they needed. And so you might have had somebody in a natural disaster that they did qualify, let's say, for $500,000 of EIDL, but they didn't just get a $500,000 loan, as in here's that 500 grand right now. They got up to 500,000. As they needed money, the SBA then lent it to them. The reason this is key is that there are really 2 kinds of future issues with those that got the EIDL, and none of it should be causing you to wake up in the middle of the night and be scared about it, but to be now aware of this because of what my clients are right now dealing with. And I've got 2 clients right now that are not getting loans that they thought they were going to get because the bank has now discovered that they had the EIDL. And that's kind of where I'm going with this. But with 2 different types of people that got the EIDL are going to have issues in the future. The first type, and I shouldn't say people, first type of business would be the business that honestly, they didn't ultimately need it. Maybe they thought in the moment they needed it. There was a lot of uncertainty. So I'm not saying that you or a business got it with ill intent, or that you got it with thinking that you were taking advantage of the system, but there was just a lot of unknown. I know when my videos were coming out about the EIDL in 2020, a lot of questions that I got was, well, I qualified for this. Should I borrow all of it, or should I just borrow some of it? But there were also a number of people that I talked to through the channel on this issue that were getting it that really didn't need it. They just saw it as cheap money. It's like, well, I mean, I went ahead and applied for it and they gave it to me. But on that application, technically, it is something that you would sign off to say, yes, I am in economic injury. It wasn't just, hey, we got free bananas for everybody who wants one. It was, hey, if you're hungry, we have some free bananas over here, and who needs one? And then they gave out the bananas, okay? So with this in mind, you're going to have businesses, maybe that you got the EIDL, you didn't really need it, but then how is that going to affect you and your lending power or borrowing power in the near future? And it's going to affect it much differently than you think. And that is also what goes into the second category, is that you have the type of business that got it the way it was intended. which is you are in economic injury, as in your business is closed, but you still have to pay either rent or some kind of utilities or your insurance, et cetera, et cetera. So the EIDL was then used. So you have plenty of businesses out there that they got it, they were in economic injury and a lot of uncertainty, and then they needed to use it, and they did. Now, unfortunately, there were lots of people in the beginning that got the EIDL, and they were kind of like Cookie Monster, and they thought they had to hurry and spend it as fast as they possibly could, and they were trying to find all these reasons to spend all the money. And I was saying, hey, stop. We are in an emergency state. So even with my clients, I said, hold, you don't have to spend any of this. You can pay it back, whatever you don't need. Hold on to it. Cash is king. So if you are in the first category and you are somebody that you got the economic injury disaster loan, you weren't sure, you had some uncertainty, but you kind of still have it sitting there. Or if you're the type of business that, normally you had 25 grand in your bank at any given time, and now at any given time you have 300,000 in your bank, this has been the first category that I would say to you, this now needs to be two choices for you. Do you go ahead and just get that paid back to allow for yourself to have lending abilities in the future under normal conditions? Or do you go, well, I'm going to count on not getting any more credit, or my lending abilities, my borrowing power has gone down. So I better then be counting on this, or this is what I have available and this is what it is going to be. And then for how long? In that first category, if you used up the money, the thing is that the banks now see it though for what it is. It's debt. It didn't matter what the reasoning was or that you were in economic distress. What the banks see is that you have debt. And more what the banks see, and I talk about it in my book, is that do you have cash flow to make your loan payments? So when they're considering new loans, what they're first considering is, do we have the reserves, meaning banks? Do we have the reserves? Well, banks across America have less reserves. I mean, even Wells Fargo and JP Morgan, they have less reserves. And it was because of what I just told you. They used up reserves and are still using reserves for PPP. Even though you can't go and get a PPP loan anymore, not all of them have been forgiven, still are in the process. That ate up reserves. That reduces down their ability to lend. So now when a bank's looking to lend, and let's just roll it back and let's just say, hey, 3 years ago, they had, 100 million to lend out, a smaller bank, let's say, or a medium-sized bank. But since PPP and where they are right now, maybe they only have, 30 million to loan out. So there's less reserves. So what does that cause a bank to do? They're going to have to be a little more picky on who they lend money to. They need to ensure that their risk is less because they even more so have to ensure that they're getting paid back. So now when we look at those that got the EIDL, whether it's you still got it sitting there or you used it all up, the bank looks at that as, well, what is your monthly payment? And what is then the amount that you actually borrowed? What is it that we would, in essence, feel is a good risk of borrowing for that business or you? And what do we feel you can repay? So many may not realize this, but when a bank's looking at a small business especially, they go, listen, based on this business, before we loan a dime, based on their cash flow, their assets, their liabilities, their accounts receivable, accounts payable, their fixed assets, their sales, their seasonal cycle, how long have they been in business? They look at it, and the underwriter, who's really the ones making the true decisions to then recommend to your bank officers, are looking at what would be really the max that this company could borrow anyways. And let's just say for grins, we're going to take a client of mine who's a law practice, and that bank, and I know for a fact, that bank would say the max that law practice should have in loans is 500,000. That's the max that they should have. Okay. So now they're going to look and say, well, what does that law practice have in loans? Whether it's with that bank or credit cards or other banks or other institutions. So in this real life example, that law practice has $1 million loan with the EIDL or through the SBA, through the EIDL program. So guess what the bank has said? This is a real life circumstance. Hey, we're not going to be able to lend you any money. We love you. We appreciate you. You've been a client of ours for over 20 years. We hang out with you. We go to lunch together. We've played golf together. You're my brother. I mean, you have helped me in so many different ways. The banker saying to the law practice, we love you. We appreciate you. But we can't loan you any money because you've already borrowed the max that your business can even borrow. Now, with this real life example, this was a law practice that I don't know really what happened, but really recently the EIDL sent an email to them and said, or the SBA, hey, you can borrow more. And I thought it was a scam to start with. And I told the client, no, don't ignore that. The EIDL program is over. They're not doing any of that. And this is somebody that had applied for an increase, and I guess it didn't go through. But then whatever SBA, they said, yeah, you know what, we'll do it. They clicked a few buttons, website, this and that, and all of a sudden they got $1 million. So we've counseled the client, like, it's just go ahead and pay that back. Okay, go ahead and pay it back. It's actually not smart debt. So many thought the EIDL was smart debt. I don't think that it's smart debt. Is it cheap money? It is, but that wasn't even the purpose of the EIDL. The EIDL is a 30-year note. Let me tell you why EIDL is not a smart loan, okay? It's meant for somebody that's in an economic injury disaster situation. But when you get a loan with the SBA through the EIDL program, and if it's over $25,000, then there's a UCC filing at the Secretary of State. And the banks are going to, if they're worth their salt, check any UCC filings to see if there are any liens, in essence, against your business, which is not a lien in a bad way. It's if you borrow money, whether you realized it or not, unless a bank doesn't know what the heck they're doing, which isn't really possible, they're going to file something, a UCC filing in your state to let any other creditors know, hey, we have first right to all of the assets of this business. So when you got an SBA EIDL, and if it's over $25,000, there's a UCC filing, and you probably are aware of it, but there is a UCC filing at the state. So when you go to renew a loan or get another loan or renew a line of credit for your business, the bank is going to be aware of it. They should be aware of it from your balance sheet, but we know many self-employed don't have balance sheets. Many self-employed, they're filing a Schedule C, which doesn't include a balance sheet. They may not be keeping books, if you will, or QuickBooks. But that is where the bank will be able to see that there's a UCC filing. And what does that again say? It says that the U.S. government is first in line for your business assets. That means that if something goes awry, the U.S. government gets your assets first, whether it's your accounts receivable, your hard assets, which means that the bank's second in line. See why if a bank says, well, we think you can handle $500,000 in debt. Oh, you already have $1 million in debt. Now we're not going to be able to lend you any more money. Now, for those that had economic disaster, economic uncertainty that then came true, so to speak, which I hope you're doing well, and I'm sorry that happened. So you used all the money. What you need to be aware of and prepared for is that, unfortunately, your borrowing power has gone down. And it's not because you're a victim. It's not because somebody was being unfair to you. It's not because you were tricked. It's not because, and I know that we can shake our fist at the sky and it gets frustrating because you didn't ask for the pandemic. It was something that really leveled the playing field from big to small business in a way to show all small business owners, medium-sized business owners, and large business owners that we are vulnerable. And so if you then used up all the money, you're going to have to pay it back, obviously. And even though it's cheap money, even though you can say, well, but it's only 3.75%, and I have 30 years to pay it back, that's a low monthly payment. the bank still has to look at, is this in essence a good risk for us? And what defines a good risk for a bank is, do we feel that this business, this small business, is borrowing too much? Because if you borrow too much, you're never going to be able to pay back. That's not a good risk for the bank. The next thing the bank's looking at is, well, we're now second in line to the US government if something goes awry. So you don't have then the same borrowing power if your assets have been used for other debt. So the thing you would be looking at then is what we're going to be talking about here. So I'm going to circle back, but bank reserves causing the concern not because banks are going to go out of business. See, and this is where the sophistication comes in, and I appreciate you tuning in. And if you're a little late, I apologize for the casualness. We literally raced to where we're staying. We got our nice cabin here with the kids. Amanda is still unloading the car. We got here as fast as we could. We ended up, long story short, it just took us a lot longer to get where we were at. We were at another location over the weekend. We traveled about 5 hours, hit a little snag, going through kind of east part of Oklahoma, which is very beautiful, windy, a lot of trees, and kind of, they're not Colorado mountains, but they're mountains to us near Oklahoma. Very beautiful, but very windy. Long story short, I'm running a little bit behind, and we took the time to get everything put up, but Amanda is getting the kids settled in and unloading the car. So you can see I look a little red. I usually don't have on just a t-shirt, but I do have on my JJ, the CPA hat. I do apologize. I can't see any comments with the setup that I've got right here. My camera, the laptop is laying on a bed. I'm in one of the rooms. I've got my microphone there. I'm going to take a quick drink. And that's all just to say thanks for tuning in. Thanks for being a part of this. I did feel it was important, though, to come and talk to you about this because it seems to be now a theme of what I'm talking about with my clients. But the bank reserves causing the concern because that's what they use to lend out. This doesn't mean banks are going out of business. It means banks are going to do more and more what the big banks have already said that they're doing. As I told you earlier, Wells Fargo and JP Morgan, they've not said we're not loaning money out. What they've said is we're going to have to be a lot more conservative. And with JP Morgan and Wells Fargo, when they then, and this was really in the last week for Wells Fargo, I believe it was, the CFO, was saying we don't plan to actually release any new reserves. That doesn't mean we're not lending out money, okay? So hopefully if you've tuned in my channel for long, I don't talk silliness and I don't talk skies falling. I don't talk goofiness, okay? But what, in essence, Wells Fargo was saying is that if they have increased their reserves, they don't plan to release those increase in reserves in the upcoming quarter, which is coming up. That just means that they're being smart is what they're being. They're not being reckless. Because remember I told you at the beginning, bank reserve requirement is 0. What is bank reserves? So bank reserves, let's see. So bank reserve requirement right now is 0. And bank reserves are funds in excess of deposits. Now, it would be interesting if you're really kind of curious about some of this. I'll just let you Google some of these words. You'll find some really good articles. There's an article that the Wall Street Journal did. And I actually came across it when I was allowing Amanda to drive for a little bit, and I didn't have time to put it in the body of this video, but it really talks about what bank reserves are and how they're kind of determined. But right now, what we have is a little bit banks have been allowed to and kind of needed to, in essence, lend out all the way up to the end of the cliff, the edge of the cliff, if you will. So, and I'm saying that in a way that the edge of the cliff is because they were told, go and give out PPP money. We'll get it back to you. And if not, you can get it repaid. It turned out it's only a 1% loan. Turns out now it's only 5 years. That's not a great deal for the bank. So the banks gave out the money And at the time, I'm assuming every single bank that gave out PPP had to have thought they were going to be 100% forgiven. Otherwise, I don't think they would have done it. But now they're going to have reserves that have been used in essence because of the PPP. And we know that last week, I think it was last Monday or either last Wednesday, I was doing a seminar the day that this came out. And so I ended up talking about it. So if anybody who's in my group 51 seminar, my private group, the seminar I did last week, catch the last 10 minutes of that. If you weren't there live, is I really, maybe 10 or 15 minutes, really kind of go through some details of what we're talking about today, but even more of a deep dive on that. But many right now are looking at this and they're like, okay, so the Fed increased the rate by 0.75%, right? So 0.75%, which is the highest increase at any given time of an increase, I think back to the 90s. That makes the Fed rate 1.75%. That makes Wall Street Prime 4.75%. So, when I'm talking with my friends that are bankers, so I've got specifically 3 different bankers that I've worked with now for about 25 years. So as a CPA, I have always wanted to have good working relationships with local banks, especially the kind of banks that are working with the kind of clients that I'm working with, so I can have a better understanding of what they're doing, why they're doing it, work hand in hand with banks in terms of decisions related to kind of the future financial picture of my clients. So doing this now for 30 years, have my own practice for 25, still practicing. I'm not a YouTuber in my mind. I'm a certified public accountant, but talking with these bankers that are good, close friends of mine, they're just like, man, this stuff is crazy. Now, this is in essence, in some regard, it's good news for a bank, right? Now, many, as I've said earlier and said it before in other videos and talk about it in my book, we think, oh, well, the banks, they just make all this money and that's all they worry about. And what do I always say? What's the number one concern of a bank? To get repaid, okay? It's to get repaid. The second is they want to make money, but they really want to get repaid, and they want to get repaid in the time frame that everybody signed off on when then the money was loaned out. Now, if they can charge more interest, that's great. What does interest do? It's more money that goes to the bank, not really necessarily for bonuses, but it can also help increase the reserves. But then what happens when we see that the banks are increasing their rates because the Fed's saying, hey, you're allowed to, in essence, and now you're going to need to do that? Well, then what we see is that the banks are going to have less people wanting to borrow money, right? So what's happening in the housing market? We know it's kind of slowed down. I know that we're just reading some articles today, mortgage business for loans, that is, has kind of slowed down. We know that, not even in that recent of times, I know that I've had clients that have gotten mortgages at under 3%. Now mortgages seem to be around 5% here about mid 2022. That's a big change. We know that when rates are low, then people can borrow more, which then means that real estate typically can be sold for more because people can borrow more to then pay for it. So we have seen somewhat of an increase. I'll tell you this, here in Oklahoma, I'm in Oklahoma City. Right now, I'm down in Broken Bow area of Oklahoma, southeast Oklahoma, here on vacation. But I live in the Oklahoma City area. And it is really, in my opinion, kind of a boom right now in the real estate market, both commercial and personal. And in big part, it's because the rates have been low. Now, I think that's going to start curbing because the rates are going up. So the rates going up, yes, is good for the banks, but less people want to borrow money. Why is this important? If you have less people borrowing money, then the banks are, yes, making more interest per dollar loaned out, but there's going to be less dollars being loaned out. This is the other reason I think the Fed actually maybe partly increase the rate. There's many reasons that they do it, but is maybe to curb the appetite for borrowing. So let's talk about the top 10 things to do now for self-employed and small businesses. And I'm going to tell you right now, none of this is going to end up being you running to your ATM. None of this is to put cash in the mattress, even though I think that can be a smart idea. Okay. I think it can be smart to have cash. I don't have cash other than probably what's in my pocket at any given time. I'm not going to be telling you to do anything drastic. What I want you to be doing is what I'm telling my clients to do right now. So number 10 is check your credit. So there's lots of ways to go about that. I'll let you figure that out, but I want you to check your credit. The big is that's your first step in knowing, well, what is your borrowing power right now in the sense of your score? Also, it's a great spot to see everything that's in your name. Okay. Now, the other aspect of this is number 9, to clean up your credit score. And think of this, when it was time for the EIDL and people were in a panic to get it, even though at the time it didn't seem as though the SBA was indicating that your credit score had much to do with you qualifying for an EIDL, we learned later that it did. And it had a big thing to do with it. And so there were many people that didn't qualify for EIDL. And unfortunately, I know that I was consulting for free with a few people that they didn't qualify for EIDL because of their credit score and because of their circumstances of not having W-2 employees. They didn't qualify for PPP and they completely went out of business because of the pandemic. So I'm not saying it's their fault, but if you know that you're going to have potentially more competition in the near future, next year to 2, in getting a loan, what does that mean? Competition. If the banks have less to loan out just because they have less reserves, if the banks are being more conservative with their reserves, which is just being smart, they're going to then be a little more picky. Okay. And where does the banks just start? They start with your score, right? It's like the first thing they look at. And even for small business owners, they're looking at your personal credit score. You know that. It's really not until you're a very large business that your business is even able to get a Dun & Bradstreet credit rating. Businesses really that are my size, the clients that I'm working with, those businesses don't have credit. They don't have a credit score. They're not big enough. So it's really based then on your credit score personally as the owner, small business and self-employed. So what can you do to clean up your score? Now, I'm not really a big fan of hiring a service to do that. Now, I do know a few clients that have done it, and it's not been all that expensive. I think you should be very careful in that. But part of cleaning up your credit and your credit score is looking at, are there some little things in there that should not be on there anymore? I don't know if you're aware of this, but starting in July, medical businesses, if the amount of debt owed to a medical business, a medical service, I guess, is less than $500, it's not reportable. Now, if it's 500 or above, it's still reportable. But there's probably maybe some small things that are on there. Maybe some old cell phone, bill situation back when you were in college is still lingering there. Some, a dentist that you went to that you forgot and you moved away and there's a, $97 sitting there, but it's somehow affecting your credit. Maybe there's a little small credit card out there that, was in delinquency. So look at your credit. Also look at your credit and make sure you are aware of what is on then your credit reporting, with the bureaus. Number 8, review your debt, break it into personal and business debt. Now, when I'm working with my clients and they're going and getting a loan, one of the things that they're doing, if they're a small business owner, self-employed, is they are giving a balance sheet for their business. So, if you're filing a Schedule C with your tax return, self-employed's filing Schedule C or even a Schedule E or a Schedule F, there's no balance sheet that goes on your tax return, but it's still something the banks want to see. Now, if you're filing an 1120S or a 1065 or an 1120, and you're a business that has at least $250,000 in gross receipts and assets, typically you're going to have to show a balance sheet on your tax return. And you're right, fellow tax pros, I know There's exceptions that are larger and $1 million in assets and all that stuff, but that's not really where we want to get down in the weeds. All I'm saying is that most small businesses that are filing a separate business return do have a balance sheet on there. But those balance sheets are really then just the business debt. Now, hear me on this. This could be the most important of the top 10 here. Number 8 is don't double up the debt that you're reporting to your bank when you're going to get a loan. Now, what does that mean? I can tell you this right now. So I'm a small business owner, right? I've had my own CPA practice for 25 years, still practicing every day. On vacation today, if you just join me. So it's the reason for the casualness. I got my hat, JJ the CPA. Amanda got that to me for Father's Day. But with my own business, when I'm going to, let's say well, in fact, here's a real life situation. I'm just being transparent. I do own my own building for my business. So I was very pleased and proud to do that back in 2018. Just a small little building. But I'm getting ready to refinance it. You're right. Maybe the rates aren't that great right now, but with the terms that I got, I'm going to do some consolidation. I'm going to do some of the things that we're talking about here. I'm going to consolidate some other things that go into it. I'm going to get a little bit better terms, and it does make sense overall. So I'm going to be doing that here with my good friend Jason here soon. But when I'm now applying for this loan, to, in essence, refinance and consolidate and kind of change up the terms. They're going to want from me as a small business owner, just like they would want from you or from your clients, they want a personal financial statement and they want a business financial statement. And those things should not have anything that really overlaps. Now, what do I mean by that? So on my personal financial statement, or for my clients, when they're putting together their personal financial statements, now I'm not allowed as a CPA to put together financial statements that go to a bank, for sure, not personal financial bank statements or personal financial statements. But when a personal financial statement is put together, it's the assets and the liabilities that are in essence not in your business. Okay. So when I have a personal financial statement, it's going to be, well, how much money do I have personally in the bank, right? How much do I have in retirement personally for me? And what is the real estate that I own personally? That's my personal real estate. So my house. What's the mortgage that I have on my house? What are some loans that I have that are personal? And in essence, that is a personal financial statement. Then on my business financial statements, you guessed it, it's the cash and the assets and the liabilities that are in the business or related to the business. Now, I'm going to tell you this, the credit card I use for my business is technically, if you go and look at my credit report, it just shows Joshua Jensen. And then my, the credit card. But that is a credit card that I only use for business. It's reflected in my business. It's on my business financials. I track all the expenses through that. It only has expenses related to business on that. So even though it's in my personal name, even though it's on my personal credit, it's going to be, though, on my business balance sheet. Why is this important? So breaking out your personal and your business debt so that when you're applying to the bank, of course, they're going to reference and go through all this with the credit bureau and the reports they get there. But you're then more making it clear, here is then the debts that my business is relying on. And then here are the debts that I personally have. So they look at then your cash flow for you personally when they're looking at the debt for you personally, right? So it's not a big deal. I'm not bragging about it, but I don't have a personal credit card, as in I don't use credit for myself personally. I just use credit for my business. Big deal. I'm not bragging about it. I'm just telling you a fact. But I am telling you this. I have several credit cards. I don't use them, but they still show up on my credit. But I'm going to list those as these are my personal credit cards that, yes, I have available. Here's a vehicle, right? Being very transparent with you. So here's a vehicle that's used personally, and that's personal debt. But the key to this is that when the bank's making a decision for the business, as in how much debt can the business handle? How much debt is the business able to pay for? I want to make sure that the banks really have a clear idea that This is business debt and this is personal debt. So breaking that out and presenting it when you go to apply. Now, many may say, oh, I got a banker. I mean, we just been together forever. I don't even know what they get. I just tell them to send me and see, I have clients that do this. They do the waving of the hands thing, right? For some reason, that makes you big time. And I'm having fun with you because I love my clients. I've downsized, so I don't have as many as I used to. So I really love my clients. But they do this. Oh, yeah. Oh, yeah. Oh, yeah. Oh, yeah. Oh, yeah. They got it. They got it. You can't do that anymore. You can't do that anymore. And one of the clients that would go, oh, yeah, we golf all the time, this and that, the bank said, sorry, we're not going to be able to renew your line of credit. So as I told you earlier, or if you're just tuning in, I told you of a real life situation. We have a law practice. They got an EIDL. They got it here in the last minute, so to speak, in terms of an increase. They got the $1 million. They went to go renew their line of credit. The bank said, we're not going to be able to renew it. Sorry. You have $1 million. But guess what they have? They owe money on the line of credit. They owe money on the line of credit. So what is the bank saying? The bank's saying, you got to pay the line of credit off. Okay. We gave you this line of credit. It expired. It is due. A line of credit lasts a year. After a year, you agreed, law practice, you would pay us back. The only reason we're not renewing it is that you went and borrowed $1 million over here. And the U.S. government's first in line. So even though bank says to my client, bank who loves my client, bank who's known and worked with my client for over 20 years, this bank lent money to my client when no one else would loan money to this type of law practice. This bank loves my client, loves them. They're super good friends. They serve on a charity board together. They're very tight. Okay. But my client got one of these, a wake up. Okay. And the wake up is this. You don't get to just go borrow money and then just think there's no consequence to it. So is it a big deal? Is the law firm going out of business? No. Right. But what I told that law practice is you're just going to need to just pay that back to the SBA, get it paid back and renew this line of credit. The line of credit is a match for your business, not cheap money. $1 million. Now everybody's like, wow, I have $1 million in the bank. No, you don't. It's not your money. It's a loan. Don't feel good about just having a big bank balance. That's just borrowed money, right? There's nothing wrong with feeling good about it. I'm just saying that doesn't really give you true security, in my opinion. And now for 30 years, the U.S. government's first in line. And here's what many are not paying attention to. When you signed off, or when this business or my client of mine signed off for an EIDL, whether you realized it or not, or whether you're like, well, no one's saying anything about it. I'm not hearing anything about it. But you wrote or you signed off in what was written in black and white. And as part of the rules of an EIDL is that you, as a business owner, do not get to pull any money out of your business for yourself. You don't get to repay yourself, and you do not get to pull out distributions. You do not get to pull out profits. You cannot sell assets. And you can bow up all you want. Well, no one's going to tell me I'm an American and I'm a small business owner. You ain't going to tell me. Well, yeah, you signed off on it. You agreed to it. What do you mean no one's going to tell you what to do? You signed off on it. What kind of an American are you? What kind of small business are you? Are you a dumb one? No, you're not dumb. That's why you're still in business. So it's not an excuse. You don't get to have emotion in it. You signed off on the loan. You have to follow the rules of it. And those are the rules. You don't get to pull money out for yourself. That's not a good loan. Okay? Hear me on that. Okay, thank you. So you don't get to pull money out if you own, are we good? You don't get to, sorry about that. Just threw me off. On the EIDL, okay, you have money that has been, hang on just a second. Amanda? Thank you, darling. You borrowed money on an EIDL. Government's first in line. You owe it for 30 years. You feel good that it's cheap money and maybe you still got it sitting there. But the banks don't see it that way. They're not going to want to now be second in line. you've used up your borrowing power, and you're now in a situation where you have a loan that has more strings on your business than any other loan. When the bank loans you money, they typically aren't telling you you can't pull money out for yourself. So small business owners have a small business to live off of. Now, what the EIDL makes it clear that you can do is continue to pay yourself a wage as a business owner, right? But most small business owners are living off of net income, distributions, as well as then wages, okay? So bottom line is that when you now are going to refinance or get a new loan, have your ducks in a row. Do it now, okay? Do it now. There were people that were going to get EIDLs and PPP, and if you're one of them, you know what I'm talking about, and they didn't know to have their ducks in a row. No one told them there was a pandemic coming. Guess what? No one knew there was a pandemic coming. So they didn't have their ducks in a row, okay? Now, don't take this at all as a slam. Don't hear it as a slam. I want you to hear it as why it's good you're listening to this right now, is that none of my clients went without an EIDL. None of my clients went without a PPP. That's not bragging. It is my clients always have their ducks in a row. Why? Because they're a better person? No. Because they have JJ the CPA that says, listen, at any given time, this is how you want to do business, right? Have good financials, clean financials, have your bank statements reconciled to your books, be able to pull a financial statement like that. Get your tax returns done early in the year. There's no reason for extensions. Tax returns for your business should be done in January, February. Listing out your debts. When clients are now having to go and apply for loans, I'm not going to put together a personal financial statement. It's like, hey, if you want me to look at it, I can, but don't include this, don't include this. So by being involved in my client, and that's what I'm sharing with you. So I'm trying to give you an edge. Because again, it's not that banks are going out of business. And if the interest rate's high and you need the money, you're still going to go borrow it. But it's going to become tougher and tougher to get a loan, not because of any other reason. And there's going to be less bank reserves. Let's go to number 7. So number 7, determine your available credit and the needs for that credit. So determine your available credit and your needs for that credit. So Mexican Ironman, thank you so much. Amanda came in and shared with me, which I really appreciate, that you just gave some money to me. And I really appreciate it. You're so generous. You did that last Monday. You're so kind. I appreciate you, my friend. And we connected on Twitter. So I really appreciate you. And nice of Amanda to let me know that. So number 7, determine your available credit and needs for that credit. So there's not really a formula that I'm going to tell you on here's what it is that you can borrow. But here's what I am going to tell you. No one is going to lend to you more than 50% of your net cash flow. Okay. What is net cash flow? Money available after expenses, whether that's personally or for your business. No one's going to do more than 50%, as in what would go to your payment requirement. Okay. So the only reason I'm telling you that is, and don't hear me as, oh, well, I guess I can stop listening because my loan payments are only at 40%. That's not what I'm telling you at all. I'm just saying, I know it's not more than 50%. And if a client were to ask me, well, can you help me know what my available credit would be? Okay. I would probably say it wouldn't be more typically than your assets, the fair market value of your assets, this for a small business, for a line of credit, and your accounts receivable. So if any given time your accounts receivable is 50 grand and the fair market value of your hard assets is 25,000, you're probably getting a $75,000 loan. And I know there's some, they're like, no, I'm going to kick my feet back. No, don't tell me that, JJ. Nope, don't even tell me that. I work with the bank and I got all this money sitting in the bank. I'm telling you, I got 2 clients that would say that, and they're not saying it anymore. And we're just having to make some adjustments. So what are you doing now? You're getting prepared for this. What are your available credit? And then what are your needs for that credit? A small business, and you may have heard me say this before, but a small business, any small business, and what's a small business? I'd probably put it at 10 million or less, right? If not $1 million or less, right? I mean, most of my clients, most of them are $1 million or less. I'd probably say, I have a lot of clients that are 500 or less. But here's my point. Any small business can be out of business within 90 days. How? You should even know that answer now because of the pandemic that we all went through, right? That's a reality now, right? That's a reality. And you probably have friends and people that you know that they went out of business because of the pandemic, which is just it's a shame. It's a crime, in my opinion. But the reasoning is if cash flow is cut, how long does a business last without any new cash flow coming in? It's got to be 90 days. I mean, that's kind of AR. Then what's happening? I mean, you're using up your immediate cash. You're hopefully collecting AR, but then AR, your accounts receivable, that's what AR is. When it runs out, where's the rest of the money coming from? Then you have small business owners like, well, I'll go into retirement. Wrong. Don't ever do that. Ever. Don't ever do that. Shut your business down. Do not go into your retirement. But my point is that when you're now looking at what is your available credit, what are your needs for that credit, that's what you need to determine before you get there. Because a bank is not going to loan you money when you need it. What do you mean? That doesn't even sound right to me. That doesn't sound legal, because I've heard people say that. They're not going to loan you money when you're destitute. When you go and you say, I got 58 cents in my bank account and I need to borrow 10 grand. Okay. Banks are not emotional. They're like, oh, well, I'm sorry to hear that. What they're going to look at is, do we have reserves? Do we have any reserves? Sorry, we don't have any reserves. I mean, I love you. I'll come over to your house and cook you dinner, but I don't have any reserves. Or, hey, do we have reserves? We're kind of tight. I can give you 2 grand, right? Because when you're destitute, you're not going to care if the interest rate's 18% or 29%. We all have credit cards that are probably sitting around 18 or 29%. You still swipe it. You still carry a balance. The interest rate isn't really the issue. Is, does the bank have the reserves? But see, the bank is not going to loan you money if they don't know how you're going to pay them back. Hey, I see you got a good name, you got a good reputation, and you're somebody that we trust. But can you pay us back? Because you might have a good reputation and we love you and we trust you. But if you can't pay us back, I'm not going to loan you any money, because banks are not charities, right? They're not bailouts. So know what your available credit is, right? And actually, if you don't have a line of credit right now, so like I don't have a line of credit right now. I used to have a line of credit, but I don't have a line of credit right now. So I went and talked to Jason. I said, hey, with everything that's going on, do you think I should go ahead and secure a line of credit just in case? Like, I don't have one. I haven't used one in a while, but should we? I've asked several of my clients that haven't renewed their line of credit just for their own personal choice. Like, they just like, you know what? I'm not going to renew it. I'm saying go and check with the bank. Should you renew it? Because the thing with the line of credit, okay, now, really, if you don't understand business, this may not make any sense to you, which means you need to get better advisors so this does make sense to you. But what does a line of credit cost you, right? Nothing more than the fee to have it. So at my bank, it's like $100, right? So if you're not a business owner, this may make no sense to you, but it might make sense as a business owner to go, okay, so if I can have a $50,000 line of credit and it costs me $100 to have it, maybe I spend the $100 like I spend it on insurance to know that I can have 50,000 available to me. Now, if you're like, well, I'm not going to need 50 grand. I'm not going to spend the $100. Then don't, and move on and just plug your ears for the next minute so you don't get angry at the fact that I might be telling a client, hey, listen, you might need a line of credit. It may not be available to you. You might want to line it up now. Why don't you want to spend $100 to get yourself a line of credit or a few bucks if you think you're going to need it? Because that's the second part of what this is. Needs for that credit. You don't wait until you need the credit to then go and apply for it. And if anything, you don't typically apply today and get the credit approved tomorrow. With a bank, it can be a while, and they got to look at documents and underwriting, and it can be a process. So I'm not just telling you to go borrow money, because what you didn't hear me say was go borrow money. I said to my clients, and what I asked my banker is, should I go ahead and reestablish my line of credit? Because see, with the line of credit, I borrowed nothing. I gave the bank $100 to process, approve, and now have a line of credit, which, by the way, I don't have the line of credit. talked about it, and we decided I didn't need to get the line of credit right now. So I didn't do it, but that's what it would have cost me. So I'm not saying to go hurry and borrow money. I'm not saying that at all. What I'm telling some of my clients that are doing is like, hey, get that line of credit set up because we're looking at your future needs. I'm looking at the past. Here's where we're at. And it looks as though you may need to go back to having some need for a line of credit. So let's not wait. Get it now. Spend the $100 or whatever it's going to cost. Because see, with a line of credit, you only use what you need. So if I got approved, which I got approved, but if I got the $50,000 line of credit, they don't put 50 grand in my bank. All they do is say you have the ability to borrow 50 grand. It's kind of like when you get a credit card and they say, hey, you're approved for $10,000. They don't just go, boom, here's 10 grand. It's you now can use and charge up to 10 grand. And then how do you have available credit? Well, you pay it down. So if you used up your line of credit, you can pay it down. But it is going to be harder. And I'm going to tell you, the second client, they didn't get an EIDL. They did get PPP round 1, round 2. They did get them forgiven. But it had an effect on their business that the bank has told them we're not going to renew your line of credit. And this is somebody that's been with that bank. It's a different one. For 25 years. They've been a client of mine for 25 years. They've been with this bank for 25 years. They said, we're not doing it. And it actually didn't have very much to do with the client. The bank is making different decisions on what market they now want to cater to. They're making changes on what risks they want to take and what kind of industries they're willing to take risks on. Right? Now, my client didn't go out of business, right? They're just having to now go find another bank. They're probably going to still be able to borrow some money. It probably won't necessarily be as much. The rates are going to be higher, right? There's a shift. But in essence, by being prepared for it, they're now ready to go and make that change. And it's not then causing them to have issues in their business. The other thing is to conserve cash. Cash is king. Now, when I say cash, right, I'm not saying go to the ATM and get out as much as you can, which I guess would only be like $400. I am not saying go to the bank and get cash. I'm talking about in your bank account, okay? To me, whether it's in my bank or in my pocket, that's cash, right? But conserve cash. This does not mean don't put money in retirement. This does not mean don't put money in your 401k. Continue to do that. You know, you don't have to put money in the market just because it goes in your 401k. It can go in your 401k and sit in a money market. It can go in your 401k or your IRA or your SEP or your Simple, and it just sits there, okay? It doesn't have to go in the market if you don't feel it's time, this is a good time to go in the market. But continue to put money in retirement, okay? Continue to pay your bills. Continue to make minimum payments. But also be conserving cash. Why? Not because banks are going out of business. I don't think banks are going out of business. But cash is king. So I do feel as though CSR, who's a great friend of JJ the CPA, Card Shop Reality, I believe that he shared this kind of throughout comments throughout the pandemic and whatnot. And so I don't think he's going to mind that I share this because it was just a reality. But there was a competitor of his, Card Shop Reality, so that's the business that he's in. There was a competitor of his in town that had to go out of business during the pandemic. And CSR was able to buy him out. It really, in my opinion, CSR did that business owner a favor because it's a specialty business. We're talking about a card shop. That's a specialty business. It probably would be hard to sell that business quickly, right? I'm sure CSR someday will be able to sell that business, but it might be a process to bring somebody in to have a specialty shop like that and to have his working knowledge. But he was able to buy out a competitor. The competitor was going out of business. The competitor needed the money, okay? So it's like, I'll help you out. And then was able to, in essence, buy out and buy the inventory. So it's tragic for that business owners that went out. They're hopefully better off for it and doing something better now. But CSR became a stronger business. Now, he didn't prey on that business. That business owner, I think, reached out to CSR and said, hey, man, I'm going out. Is there any way you can buy out my stuff? Like, otherwise, I don't have anything. But CSR was able to make a good position for himself because he had the funds to be able to do that, right? He had the funds to be able to do that because he's a good business person. He conserves money. He's, in essence, smart with his assets. So conserving cash will help you stay competitive. Not necessarily buying out your competitors. Maybe that happens. But you don't want to get in a position where you're making, in essence, long-term decisions based on short-term economic standing, right? So I have a client that it's a separate law practice and a huge law practice, like a really, really big law practice, well-respected. And this particular lawyer is a great friend of mine. We've been working together now probably for over 15 years. And they got themselves in some circumstances, this is probably about 10 years ago. And it was because they were involved with a big case and there was a lot of expenses related to that. And they needed to borrow more money to fund the case. They weren't borrowing money to make rent, to pay themselves. Talk about borrowing money to fund the case. And it was a tragic situation. But nonetheless, it was requiring a lot of funds. The banks got to where they're like, we're not going to lend you any more money. We're just not doing it. So my client came to me and they're like, hey, should I put my own money in? No, do not put your own money in there. No, that's your money that you pulled out as profits. That's not what you do, is put profits back in the business for something like this. Like, well, should I borrow against my retirement? No. Should I pull money from retirement? No. Should I use my personal credit cards? No. So he did go and find some additional financing by bringing another law practice in. They charged a kind of a premium, in essence, to come in and do a part of that. But why am I telling you all that? I was telling the client, preserve your personal cash, preserve your retirement. Don't use those things. That's what causes you, by using those things up, to then start making bad long-term decisions based on short-term situations. Consider what debt to pay off to have available credit later, but ensure you can count on it. And what does that mean? It makes sense to start paying debt off. Now, I say, hold up a second, right? Because a lot of small business owners, they go to a mindset of, I want to be debt-free. And I'm all for that. I really am. But there is time that debt makes sense. When does debt make the most sense? So I have a client now, they've sold their business number of years ago. But this was a business that would buy up raw materials, make a product, and then resell it. And they did it so well that they had a much larger competitor come in and say, hey, can we buy you out? And they were able to buy them out for enough that they said, yeah, you know what? We'll let you buy us out. But they had a line of credit that was really kind of equal to or less than kind of what their raw inventory cost was at any given time. So if you're a retail store and you go, well, what would be an appropriate amount of line of credit? Well, something equal to the assets that line of credit is using for operating the business, right? So if somebody always has at any given time, $300,000 in inventory that's buying and selling, and they have a line of credit of $300,000, right? That's still a big line of credit. But in essence, you're going, well, I'm using the bank's money to then fund this inventory. And what is the cost? It's interest, right? But I can tell you right now, we have another client, and I do not feel, even with the inventory that they're carrying, based on economic circumstances, that they would be able to actually get a line of credit equal to the inventory that they're carrying. So they need to start making some longer term decisions on, do we want to carry as much inventory? Do we need to change how we're buying inventory? But consider what debt to pay off to have available credit later. Be sure that you can count on it. So that kind of leads into number 4, which is consider paying off debt with what's called the snowball approach. I didn't come up with this. I think this might have been something I read in NerdWallet or Investopia. So I don't want to take credit for it because I thought this was a great idea, and I'm sure that you may have heard of something like this. But consider paying off debt with a snowball approach to paying off the smallest balances off first. Now hear me on this. You have to find a balance here, y'all. Okay. You don't just start running in the direction of, I want to be debt free, because you may be debt free. Okay. But then you're going to look over here and go, well, I don't have any cash and no one's going to lend me any money. And I can't renew my line of credit. And now I'm out of business. You have to find a balance, right? Healthy amount of money in the bank, a healthy amount of debt that keeps you strong. But what am I talking about here? Most likely is potentially your personal debt. And now many small business owners, they go, oh, you know what I'll do? I'll just go get myself a big old loan. I'm going to go pay off all my little debts. I'm not telling you to do that, right? What did I tell you earlier? I told you to, in number 8, I said, break out your debts between business and personal debt, right? So now if we're looking at personal debt, what's personal debt do? It eats up your lending power. It eats up your borrowing power. It affects your credit score. So snowball, yeah, definitely can work for your business if you have a lot of little creditors out there, but also for the personal. But snowball is also, think of this. So let's say that you have, 5 different credits, 5 different things you're paying loan payments on. So whether that's credit card, line of credit, or a note, right? So snowball approach is, okay, I'm making payments to all of these. So I'm going to go to the smallest one and I'm going to pay that off. It's $1,200. But that $1,200 is costing me $50 a month. So you pay the $1,200 off, but then you now, as you move forward, you're going to use the $50 that you were spending on that smallest debt to pay off the next smallest debt plus anything extra, right? Because many in just working with clients for over 30 years, they'll pay off that debt, but then they're like, oh, now I freed up that $50 a month. The snowball approach is, well, hey, you did free up the 50, but now start using that 50 to start paying off towards this other debt. And basically like a snowball that gets, now you go further along and now you're just paying off the bigger debt. Now, what the other approach is to consider paying off debt with an avalanche approach of paying off the highest interest rate debt first. So you just have to find a balance here. You might kind of like, maybe you're doing both, but remember this, whatever has the highest amount of interest rate, then a lot of your payment that month is probably going towards interest, which then you're just kind of treading water, right? So if you're in a position where you're like, well, every month I'm paying out $7,000 in debt payments, look at how much of that is actually going to interest, because then that's the amount that's not actually getting you ahead of the game in any way, shape, or form. So you have to find a good balance here. It could be, well, I'm going to pay off me smaller ones, but I also want to start paying towards my highest as well. And that would be something that I'd say if your biggest debt is your highest interest rate, and it would be a while before you were able to start paying off your bigger debt that had the highest interest rate, well, you may want to kind of balance that out. But why? Okay. Why do any of this stuff? Okay. Is so that you can have a better credit score moving forward. Why? So you can be more competitive. What do you mean? That you'll be more attractive to a bank to be able to borrow money when needed. Okay. When needed. Consider, number 2, consider paying off debt that the interest is not tax deductible. Now, this is something to really kind of weigh here. Remember, with all of this stuff is a balance. So I don't think many that tune into my channel fall for clickbait. I think those that are tuning into my channel, and especially if you've made it to here, I appreciate you. I love you. I hope you will subscribe if you haven't already. But those that tune into my channel are typically going to be those that are sophisticated. And what I mean by that is that you're seasoned. I did a poll before we started doing this live show. This is our 8th episode. So about 10 weeks ago, I did a poll, and I was really pleased and a little surprised that a lot of those that tune into my channel have been in business for over 10 years. Many that tune into my channel have more than 10 employees, which is, in essence, we're dealing with now those that when you're sophisticated, there's just no one way to do it. You can't watch a 5-minute video and somebody got you revved up and you're ready to run through a wall and run a marathon and get out of debt at the exact same time, and you're going to do it all by 6 a.m. That's not realistic. Okay. That's not who I'm talking to. Okay. If you need to run through a wall, run a marathon, and have all debt paid off by 6 a.m., you probably fell for something, and it was probably a sales pitch to then do something that you really shouldn't be doing. Sophistication here is now looking at all the things I talked about. First of all, cash is king. Second, in the terms of like, what would I say is most important? Having cash on hand is most important. What's second? Okay. To have the least amount of debt. But let's think about all this, and that's where we're doing this. But when we talk about not tax deductible, this would be in essence things that aren't in your business. So when I have business owners, so I have clients, and I'm often asked, "Hey, I just came into some dollars, or I got some extra money coming in, or I got a big case, or got a big sale. I'm wanting to pay off some debt. What do you think I should pay off first?" I'm like, "Well, hey, listen, anything in your business, we get to write off all that interest, right? It doesn't make it better. I'm just saying it's just a starting point, right? So if we're like looking at, I got 10 grand, where do I want to go pay the debt? Well, this here with the business, you get to deduct that interest. So what's on the personal level that you don't get to deduct the interest? So a personal credit card, right? A department store card. If you go buy a washer and dryer or furniture or anything personally, that interest is not deductible. There is some interest that you pay personally that is deductible, student loan interest for one, but it's limited to $2,500. And if you make too much money, you don't even get the deduction. So if you're curious yourself, go to Form 1040, go to Schedule 1 of your tax return. There's a line item that says student loan interest. You'll see how much did you even get to deduct. Now, we know in 20 and probably in 21, there weren't a lot of payments being made or weren't required, so you may not have any there. But my point is student loan interest, yes, is deductible, but if you make over a certain dollar amount, you don't get the deduction. And then no matter what, you don't get to deduct more than $2,500 of that interest. Now, here's the other thing. I had a client, so a doctor client of mine, he is kind of in his second career, so to speak, still a doctor, but he sold his practice and now he's still doing medical stuff, but kind of a different service that he's providing and doing really well at it. And one of the things that we talked about is he kind of has been saving up his money, and he was kind of like, I think I just, I'm going into retirement years. I think I'd just like to go ahead and pay off my house. And, this is somebody I think he's lived in his house. It's been a long time. Didn't have a lot of debt left on it. But nonetheless, let's just say, I want to say it was around 100 grand that he has left on his house. And I said, well, the first thing is, I don't think you should just plop down 100 grand. Like, don't just pay 100 grand today. You can kind of get into what you call paying off debt remorse, right? It's like kind of like buyer's remorse, and life changes. You might all of a sudden be like, oh, you know what? I needed some of that cash, or maybe I could have done this with the cash. So I usually tell people, if they come into a large amount of money and now they're wanting to go pay off a hunk of debt, I say, maybe just do it over 90 days, right? Now, for those who are like, well, I just can't believe that you suggested that. There's 90 days of interest that they just didn't have to pay, that they could have paid. Let's come back to reality. Let me pull you back down and let's talk real world situations here, okay? And real world situation is just what this doctor had. His wife now has a medical situation and is not going to be able to work, and they have different cash flow needs. And that all happened in a blink of an eye. But anyways, the client said, and this is all something that's happened really probably in the last 6 weeks. Hey, I got some money. I think I want to pay off the house. And I said, well, why don't you pay off like 25 grand this month? And, maybe 25 grand next month, or maybe 25 grand next quarter, 25 grand the quarter after that, or pick a time frame. But I don't know if you just pay 100, pay it off, because you're not going to get that money back. But then, this is before we knew about his situation with his wife. He called me and he said, hey, my wife, and I'm not using client names here, but I know these people forever. But anyways, he said, my wife, of course he said his wife's name, but my wife said, are you sure that we should pay off the mortgage because we get the deduction? And I said, hey, doc, guess what? You actually don't get the deduction. He's like, what are you talking about? I said, your standard deduction is high now under the current law. And especially at your age, you even get extra standard deduction. So given that your state taxes are limited to $10,000 as a deduction, state and local taxes, so real estate in the state of Oklahoma, you only get to deduct up to 10 grand of those as an itemized deduction. Your mortgage interest, you don't even have that much mortgage interest. And then you do have some charity, but we pay that through your business and it's a sponsorship. So I said, you don't even itemize your deductions, meaning you're just taking the standard deduction because the standard deduction is higher than your itemized deductions. So you aren't actually yielding a tax benefit from your mortgage interest. And it's only because you get to take the higher of your standard deduction or your itemized deductions, and your standard deduction is higher. So your itemized deductions, we wouldn't want to take it because the standard deduction is higher. So all I said was, you're not getting any benefit, so it wouldn't matter. Go ahead and continue whatever the plan is. So he made a chunk down, and they're glad that they didn't just pay it all down just right then. All right, let's go to number 1, and I'll try and wrap up. So plan on having less borrowing power in the near future and adjust now to avoid that causing your financial hardship later. So, right, I mean, I'm not going to probably be able to remember it right off the bat, but, there's that old saying, which is those that fail to plan, right? What happens to them? They fail, right? So if you fail to plan, then you should plan to fail. I mean, that's the saying, right? Now, I have plenty of clients that just somehow are like a bush pilot, and they're always on the seat of their pants, and they're always about to crash, and somehow they pull up and they survive and they make it to the next business to the next day or the next week. And guess what? That's most small business owners, right? I wish I could pull up this video I can describe to you in my mind, but Amanda sent me a short little video that we shared with her son, who's an entrepreneur. And it was an old time movie, like must have been made back in the 20s or 30s. And the caption said, "The Daily Life of an Entrepreneur." And it was somebody that was on the front of an old train, like a choo-choo train, right? Like the smoke's coming up out of it. And those old trains kind of had a slant front. Anyways, this entrepreneur, this is just a person in the caption saying entrepreneur's daily life. The entrepreneur, or this person, is like leaning on the front of that train while it's just moving very, very slowly. And they're coming up on the tracks, and there's a big piece of wood on the track. So he has to jump off, run forward. Obviously, that's how slow this train's going. And pick up the board and put it in his arm so that the train won't hit it. And then something else happens, and then they got to go put the wood down because it turns out that wood shot up from another part of the track that had come apart. And now he's got it. My whole point is that entrepreneurs every day, what are we doing? What small business owners doing? What are self-employed doing, right? Answering the phone, solving problems, talking with somebody that wants to know why their product isn't there, or when the service is going to be done, or why did it cost this, or explaining why they need to pay now, or approving vacation, or making sure that the person who's supposed to take the garbage out actually took it out. And do we need to buy 10 stacks of paper or 3? And should we buy Diet Cokes or Cokes, or what's everybody want now? Can somebody have off Friday? When's the next holiday? Oh, by the way, when's business coming in? What's the new product? Oh, the software's changed, right? So we're dealing with this every day. You as a business owner, you're keeping your business going. You're rocking and rolling, and we love it, right? What's a small business owner? What's an entrepreneur? What's a self-employed? Somebody that was willing to work 80 hours a week to avoid a 40-hour-a-week job, right? Working all the time. I mean, look at me. I'm on vacation. I'm in the woods. I would turn it, and maybe I'll try at the very end. But I mean, I'm in the middle of the woods. I'm in Southeast Oklahoma. I love you. Still talking with you. I'm a CPA. I'm working. My brain's going. We're driving through the woods today. We're enjoying ourselves, talking, read a few articles, but right, all the things are moving along. So my job working with my clients is, well, what's coming up? I don't want my client on the front of the train. I don't want you on the front of the train that's now going, oh, shoot, that piece of wood that's 5 feet away is blocking us. I better hurry and jump off and get it. I would rather you know, hey, a mile from now, there is a big piece of wood on the tracks, and you're able to call ahead and solve it before you even get there. and then your choo-choo train's not going this slow, it can go that fast. That's what I'm doing with my clients. That's what I want you to do. That's why I'm glad that you've tuned in today, because what we're seeing is a reduction in reserves is here, and there's going to be more than selection process on who can get loans. And that then is going to change your borrowing power. So if you've got the EIDL, then you might be in a position where your borrowing power is down. If you got the PPP, that's great. You shouldn't have any real effect there. Even if you're having to repay it, it shouldn't be a big deal. It's over 5 years. It's a 1%. But at the same time, that's affecting the banks as a whole and their reserves. And any loans that they're getting repaid, they're only at the 1%. We also know that banks are saying now we're going to be more conservative in giving out loans. We know that the interest rate's going up, which means that demand is going to be going down. The other thing is that when things become more expensive to borrow, then that also makes business more expensive, right? There's a lot of businesses maybe out there that you're doing business with. So even if you're a debt-free business, which is great, but you're doing businesses with businesses that are using debt. I mean, if you go and buy stuff from Office Depot or Staples, they're using debt. If you go to the vendors that are selling you something that they're creating, right? They're taking raw materials, they're creating something, they're selling it to you, they're using debt. Those things have an effect on you and on your business in lots of different ways.
Subscribe now. Subscribe now. Subscribe now. Subscribe now.
Oh my gosh. All right. So my producer, which is my fiance, Amanda, because she was unloading and getting the kiddos, she hasn't been able to do her producing today. So I apologize that happened. You can say hi to everybody if you'd like.
I wanted to tell you a couple. Whoops.
Oh, okay. Okay. Here, you want to read them? So say hi to everybody.
Hi. So I missed you guys, but I've been on the chat. But a big shout out to Pocket Watching with JT and
Pocket
to
Watch.
Tony D.
Tony
for
D.
your donations. Thank you.
Well, thank you so much for that. I really, really appreciate that. It means a lot.
Yes.
Yeah. Thanks for coming in
Welcome.
to tell me that. All right. Well, since you're here, hold
Yes.
tight. We want to hit all our buttons. I think I said, would love for people to subscribe.
Yeah. So hit
Thanks
that
for the
again to
support.
make it go away.
Oh, I got to hit it again to make it go away. Okay. Because I just hit the subscribe now.
Yeah. See, I
100
only
times.
teach him a little bit, so then he has to keep me
That's
around.
right. That's right. Okay. So hit this and that hides it.
Uh-huh.
Okay. There we go. All right. So then this will be the last thing that I hit is right there.
Right there.
Okay. So if you made it to here, you're part of the family and you're glad to see Amanda over here, and kiddos got in okay, right?
Yep, they are
So
here.
we raced here. We had to get to the grocery store, we had to pass where we're supposed to be, go down the grocery store, which is right about 13 miles south of where we come back. And we had all the groceries in the car, but we had to get them up in here so that we can get them in the refrigerator. Left everything else
Yes.
in the car. Bless your heart.
Yeah.
I helped you with the
You did.
heavy box.
He did. He helped me with all the heavy.
And then we thought I was going to do this outside, but the lighting was no good. So then we came down here and I was like, well, maybe I should have a plant. And I'm like, why am I doing it? We need to go live. Long story short, thank you for being here today. Thank you for all the support. I'm sure if you've made it to here, you're a subscriber. If not, I would love it if you'd subscribe. I don't make any money off you being a subscriber, but it does show I'm putting together good content. I'm close to 80,000. What a monument that will be. And I will feel so honored. When we started this channel back in May of 2018, we were hoping for 10,000 subscribers. And after 2 years, we only had 2,500. And when the pandemic hit, I started doing videos for my clients. And then all of you started listening to and showing your support and love. And we really appreciate you. So this week, I think I've shared with you before, we had a holiday a couple of weeks ago. We went live, even though it was a holiday, for the show, and shared some things. But we don't own a boat, but we're going to be renting a boat a couple of days this week. And this weekend, we were spending some time with Chloe and Cooper. This week, we're going to be spending some time with Shane, Carly, and Nicholas, as well as Reikley. And so anyways, we're down here, Southeast Oklahoma. We just love it here.
Oh,
Going to be Broken Bow Lake. It's ran by the U.S. Army Corps. Is that how you say that?
Yeah.
But anyways, which means that there's no houses on the lake. They only let kind of smaller watercrafts on it. So it's one of the cleanest, it's the cleanest lake in Oklahoma. It's huge. We can go pretty fast on our pontoon. Maybe I think we go, I don't know, it feels fast when on the water. It couldn't be more than like 22 miles an hour. But anyway, it's fast on the water. But we can jam for almost an hour straight, kind of going through without stopping. That's how big this lake is. So we have a great time. And we're so excited that the town here is really getting blessed. It's a good life. It's Beavers Bend Marina is where we rent our boat at. And you're not gonna be able to find us. I mean, we're in a cabin that's not even on the map. We dropped a pin and sent it to Carly and Nick.
And then that pin still didn't work. So.
Oh, it didn't. Yeah. I mean, where we are, there's no roads that are on the map yet because they're just so new. All just to say, this is how much I love you and I appreciate you, and committed to those that are tuning in here and the subscribers that JJ the CPA is a champion for the small business. I'm an optimist about what we're doing here. Thanks for tuning in today. Thanks for tuning into the channel. I am hoping, and I have said this now for a lot of weeks, but I've been hoping to be able to put together some videos. But I had a stroke back in October, fully recovered, but it changes kind of a little bit of your priorities and time and all those kind of things. So, all right. Well, let's see, we got here. Just want to give a quick shout out. We got Z Robert 66 and Tim and Reginald and the Amanda with flying colors. Hope you're doing. Thank you. Yes. 100,000. Oh, we got Mike Fisher, CPA. Much love, Mike. I saw your email. Appreciate you. Glad things are going well. Celebrating life. Just kind of speaking between the lines there. You know what I'm talking about there. Appreciate you. And many of these take my continuing professional education. Mike is one of them. Appreciate that. And we got Dawn and God's Dozer and Mary Ann and S. Phillips. How you doing, my friend? S. Phillips was the winner of our Cracking the CPA Code contest back in 2020. We got Lori and Stacy and Carol. Hope you're doing well. Carol's a big help in the comments, especially. And Reginald and we got one cool P on with us. Love that. We got Theo and Vivian and let's see. Oh, and Mexican Iron Man. Rob, of course. Appreciate you, Rob, of Imagine That Toys and so many others. Thank you so much, Sarah Kay. Good to see you. Listen, I look forward to seeing you all next Monday. Next Monday, I don't know if he'll be live on with me, but a fellow CPA we struck up a friendship going back a ways, and we've kind of shared emails and had fun with each other. He hired me for a phone consult, which I'm honored by, but he hired me as a phone consult, I believe, back in 2020. Kind of stayed in touch. Here's the long and short of it. He is coming to town next Monday, and we're going to have lunch together. He said, hey, I'll pay you for your time. I said, no, you coming to see me. You're not paying me for my time, CPA to CPA. But anyways, I don't know if I'll be able to talk him into coming on our live next Monday, but we're having lunch next Monday. Going to meet at my office. I'm very excited about that. Humbled, honored. Someone's flying all the way out. I think it's from Georgia.
Yeah, I think it's from Georgia.
So we're looking forward to that. So we might maybe we'll have a live special guest. We'll see. They can kind of tune in. All right. Well, we better get going. Definitely longer than normal. I thought it was going to be abbreviated and should have known better to even say that. So with that, thank you for tuning in. I'd love it if you'd subscribe. And then don't you ever forget, you've never met a CPA quite like me. Thanks so much. I appreciate y'all. Look forward to seeing y'all soon. Thanks for all the love and support. Know it goes both ways.